Hello guys and welcome to another video. My name's Mark, I'm an entrepreneur and property investor. In today's video, it is the 7th of June. Halifax have just uploaded their new house price index and I am gonna film, edit, deliver it to you by the end of play today. So wish me luck. And if you like this sort of tenacity, if you like this sort of content, talking about property prices, investing, wealth, please give this video a big like. It really does help me out with the algorithm. And if you haven't already, consider subscribing. Until I get to 10,000 subscribers, if you want to speak to me one-to-one, you can book an absolutely free of charge call. There's nothing to sell to you. I'm not going to try and sell you anything. You can connect. We can talk about property. We can talk about investing. We can talk about business. We can talk about anything that you want. Just fill in the form in the description and me and you, we can connect one-to-one on Zoom, 15 minutes and have a quick chat. I want to connect with my subscribers and make sure we build a really, really strong community. Now guys, we've got this report in front of us and it contains some really interesting information. And it's some of the ideas that I've been sort of talking about over the last year or two. And I feel that now the data is really starting to support the things that I've been saying. The first thing I really said about 2 years ago when interest rates really started to rise was that this is going to have a huge impact on house prices down south, where the cost of living is going to be really bad. If you took out a mortgage that was £1,200 a month and it doubles to £2,400, that's a huge issue. Whereas if you've taken out a mortgage that's £300 a month and it doubles to £600, okay, you're still going to feel the squeeze. But the minimum wage is the same up north as it is down south. And what I've done there is just allude exactly what this report gives us. And I'm going to, in this video, sort of talk about my investment strategy, what I've been buying, what I'm going to continue to buy, my thought process behind it, how the data is leading that, because we need to be data-led. We can have an assumption, we can have a thought, we need to move fast, but at the same time, we then have to be data-led. And the data is now starting to support all the hypotheses that I held, and I'm going to show that to you right now in this video. So let's run through the headline statistics, if you like. Average house price, £288,688. That's driven obviously a lot by down south. If you think, once you get to the Midlands, a 3-bedroom house is costing you nowhere near that. I buy in Kettering, Wellingborough, Corby, all around that sort of belt around the Midlands, still 45 minutes into London on the train. And an average 3-bedroom house is 180 to 200. Now I was buying them for 130. I even bought one for 115, but that was 4 years ago. And this report kind of talks about why that's been happening and why those price growths in those areas are so vast. But for me, those are still affordable. They're still well below the average house price, and it means that people can still get on the ladder. Once you go further north, I've also been a big fan and advocate of Sheffield. I've got 5 properties in Sheffield, I think. 4 properties in Sheffield. Again, I've seen massive house growth over the last 4 years on those. So when we go into this data, although the average house price sits at 288,000, once you get above sort of the Midlands, or even including the Midlands, the average house price is way lower than that. So it's really driven up by the south. And this is where this report really sort of shines some light on what's going on with the property market. Monthly change, 0.1%, makes no difference, it's basically zero. Quarterly change, 0.3%, annual change, 1.5% to the positive. Now 1.5% annual change might sound good, but inflation's running at 3%. So if inflation's running at 3%, in nominal terms, whilst your property prices will have grown, your real terms property growth, once inflation's taken into consideration, has shrunk by about 1.5%. So as an investor, I think of this 2 ways, and this is really key. Inflation is my friend on the debt. It really is. I've got £2 million worth of debt. If I get 10% inflation in 1 year, I essentially lose £200,000 of debt, even if I don't pay off any of the principal. I just have that eroded by inflation. On the other hand, it inflates the house prices normally and the rents. So it really does, and it's very important for an economy, for the currency, to have inflation because it sparks demand. If the goods and services that you're going to buy every year got cheaper, then people delay making those purchases. So it's absolutely essential that economies have inflation. But when it comes to my property portfolio, it helps me in 2 different ways. It helps me on my rent, it helps me on my capital, but it also deflates the value of my debt. So taken all together, the annual house price change of 1.5% to the positive, inflation at 3%, it paints a fairly mediocre picture in the world of property when it comes for a year's change. Now this is where it gets a bit more interesting though, I promise you. Up north, The Northwest is the strongest performing national region where house prices grew by 3.8% on an annualised basis. And this, in my opinion, is driven purely by the cost of living. Those house prices were much cheaper to start with. It's now the highest performing region. Second highest performing region? Guess what? Northern Ireland, another area where house prices traditionally were much cheaper than Southern England. Areas where house prices have dropped the most, Eastern England, South of England, of course, those are the ones that are taking the biggest hit, because those are the areas where consumers and where customers and where people who are buying properties are having the biggest squeezes on their mortgages. Now, this isn't everybody. You know, a big proportion of the UK property market is cash buyers. And if you're an investor like me, quite often it's hard to believe that so many people buy in cash. In the UK, I think it's about 40%. In fact, I'm going to Google it. I have Googled it, I was wrong, it's 34%, but that's still a very, very big proportion. And if you consider, you know, as people age, they generally have the wealth behind them, they might not have the appetite for taking on mortgages, they might just want to sit their money in a house and buy it for cash. That's that part of the market. So a third of the market is unaffected by interest rates. But that still leaves 2/3 of the market that is. And down south, if you had a mortgage of £1,500 a month and that's just become £3,000 a month, well, that's a big problem for many, many people. And that's why the south of England is seeing these drops. I know people who have been massively impacted and they're having to sell their houses. People who were buying at the maximum of their affordability when interest rates were low, and now interest rates are higher, they just can't afford the mortgage payment. So it's a very real problem for a lot of people. Up north, I know quite a few people as well, I'm not hearing the same things. People are going from £400 mortgage to £500, £600, £700. It's not a big issue, whereas if you're going from 1,500 to 2.5, although the percentage might be the same, the amount is very different. And minimum wage is the same, whether you're down south or whether you're up north. It's exactly the same. So if you bought and you were in a median paying job, let's say, maybe not minimum wage, but median paying job, which is about 30k in the UK, you're in that median paying job, then you may well be stretched out of the market down south, whereas up north, you're still comfortably within your affordability. So what does that mean for me as an investor? Well, it means I'm going to continue doing what I'm doing. For the last 4 years, I've been buying properties around the Midlands, up north, where I've thought that they seem cheap. I justified to myself minimum wage is the same in both of these locations. I'm buying family homes, right? 3-bedroom terrace houses. Those people quite often are going to have kids. They might be on a single income or one single income and a part-time income. And I justified to myself that the wage divide from north and south, when you look at it, apart from in the higher professions, is not that great. And because the wage divide isn't that great, the property disparity seems vast. So I made that justification to myself 4 years ago. Today, my returns are looking much better on my northern properties. And now I'm going to continue doing that. This is just hammering home the point to me even more. I fiercely believe that where you've got properties, 3-bedroom houses in Sheffield, £130,000, they've got so much growth in them. Now there are areas up north where I would just stay clear of with declining populations, and a good example would be Blackpool. And if you live in Blackpool, I mean no offence, and if you invest in Blackpool, you know, you're a braver man than I am. But they have a declining population, they've still got new supply. Whereas Sheffield, big university city, lots of people going there, it's a vibrant cosmopolitan area, lots of jobs being created, fairly low unemployment. It's not got high unemployment like somewhere like Manchester, which has got high unemployment versus Sheffield. I think the economics within that city look really good. And Sheffield's still much cheaper than Manchester. So that's the reason that I kind of picked Sheffield. The other reason that I picked sort of the northern area around that Wellingborough, Kettering, Corby, the Midlands belt that I sort of described, 45 minutes into London on the train. It's so quick. In Didcot, we have a big commuter base and it's 45 minutes to London on the train. Average house price, probably £400,000. In Wellingborough, Kettering, Corby, those same houses, £200,000. Half the price, same distance into London. So I see that there's a lot of capital appreciation to happen there. And when I was buying them at 120, 130,000, I was saying in 5 years, they'll be 200. And guess what? 4 years later, we're almost there. I still think that there's a lot to go on those. But guys, what are you doing with the property market? What do you read into this? What's your plans for investing? Let me know in the comments. As you know, until I get to 10,000 subscribers, I'm going to answer every single comment as well as do these free calls. So let me know in the comments. I will see you on the next video. Like and subscribe as always. I appreciate all of you and I'll see you soon. Cheers, guys.